What decisions go into investing in private real estate? This week, we'll be talking to an industry veteran who uses private real estate to build portfolios for retail investors. And we'll be talking specifically about the decision-making processes he uses and the considerations that his firm makes when they make better wealth decisions.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision-making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
Our guest this week is Josh Will. Josh has over 20 years of executive experience in the asset management industry. He's currently the president of Virtus Capital Corporation and Virtus Real Estate GP Inc. His primary focus is to lead the company into its next phase of growth and to take advantage of current market conditions. We're going to be talking real estate. Josh, how are you today?
I'm really good. Thanks for having me on today and looking forward to chatting about real estate.
Great. I always like to begin by asking, what can you tell us about who you are and what your background is?
So again, thanks for giving me the opportunity to do this today and talk about real estate. I've been in the real estate sector for all of my career and always in the private market side of it and working with private managers, creating product for various real estate holdings, whether it was long-term land plays or income producing real estates, putting together mutual fund trusts, mix, things like that. And for a brief period of time as well, I actually owned my own securities dealership where we got our registration to package these deals and bring them to the market. So I've partnered with a couple of guys that have more experience than I do in this space and a lot more years and gray hairs to add to our tenure across our whole partnership. And I've been learning a lot. And, real estate is one of those things too. I'm always learning stuff every day, every single day, we're learning stuff new. So it's a pretty cool industry and happy to be on the show here and talk about it.
Perfect. Okay. So I saw on your company's website that your firm is founded on the simple idea of providing genuine, thoughtful advice that puts your vision at the center of the firm's focus. So to that end, I have some open-ended questions about themes and process and overall decision-making. I want to begin by asking what your thoughts are about the current rate environment. We're in a situation right now where global inflation may be decelerating. There are some people who think that's the case. And despite a bit of an uptick in inflation recently, there's a view that inflation is more or less subdued and that we might even be getting a rate cut south of the border in September. What are your thoughts?
Yeah, that's a great question. And there's a lot of opinions in this space. And if you're watching some of the news that we have south of the border, there's some very aggressive opinions on the rates and what should be done there. Yeah, I think we've definitely seen a compression on the inflationary rates. I mean, the government's done I'd say a pretty good job, although it was a little late coming to the party and coming to the table to take action. But I think the most recent numbers were down significantly year over year. I'm amiss. I think it was about 1.7, I think was the latest number that came out. So we're certainly starting to see that the inflation come down, which is great. And things are starting to again become, I don't want to call them affordable because we still live in this, I would say, a very expensive life that we are living right now. It just is what it is. And hopefully interest rates will come and reflect that. I would say that it's a tough one to say, John, if it's going to be going up or down. What we have seen is a lot of periods where they've just kind of held their own and haven't done too much yet. I think everyone's kind of scared to make a decision if it's going to go up or down. I can tell you from a real estate perspective, one of the things that we like, and I get this comment all the time from friends and family. Matter of fact, it's funny, I'm in my garage right now as we do this, and I had a friend come over yesterday to watch the Tour Championship, and he was telling me that he's renewing his mortgage today. And he said, Josh, what should I do? Should I go variable or go fixed? And, I don't have the right answer. I don't have a crystal ball. But what I can tell you when it comes to real estate, one of the things that I would always, advise is that you always want to make sure that you're able to pay your bill. And if you know exactly what your bill is going to be, it certainly makes life a lot easier. So I don't necessarily know what's going to happen with the interest rates over the coming months, but I can tell you that when we have the opportunity to refinance or whenever we're purchasing anything, I like to stay with fixed rates because I want to know what my bills are going to be next week.
Would you say people in the real estate community are actually rooting for central banks to start cutting rates, or are they more sanguine and indifferent?
You know what? I think so. I mean, rates have kind of, they went up and down very quickly in the last, 24 months. I would think that, as a real estate manager myself, interest rates going down is always a good thing for us. It makes our property values, kind of go up. But it also creates a lot of competition when we're out there buying. And that's exactly what we saw between 2021 and 2022, where interest rates obviously took a dive and then inflation went through the roof. Money was cheap. So, when it's cheap, that's really drives values up. So I think there's some managers that probably bought a lot of stuff between 2020 and 2022 that are now starting to come up for refinance, and their interest rates, have gone up quite a bit. And, a 2.25 interest rate to a 4.5 interest rate is a 100% jump in their cost of capital. So those managers are probably saying, yeah, I'd like to see rates come down a little bit because that's going to affect my cash on cash return here. I think overall, the industry is probably hoping that, we see interest rates come back down a little bit.
Maybe you could walk us through the decision-making process. The podcast is called Make Better Wealth Decisions. And I'm interested in, and my listeners are interested in, your decision-making process. And you're just one person, and to the extent that you can speak for the industry, even better. But walk us through the trade-off. So, what are you thinking about in terms of the possible appreciation of this property? What about if we did a leasehold improvement? What would happen there? Are we going to be at full capacity in terms of having people paying their rent? What considerations go into when you buy a property, and also when you might decide to exit and move on to something else?
Yeah, there's a lot to unpack there, John. One of the gentlemen that sits on my board, a guy by the name of John Pizzacalla, he likes to use the saying, you can't get hurt in the dirt. And he's kind of right. I mean, it all depends on when you get in and when you get out. So if you got in, let's call it 2021 or 2022, and you're looking to sell in a period like we're at now, where we're seeing a bit of a compression on the values, you can get hurt in the dirt. I've got a number of stories I could point to in my own neighborhood here where I've seen residential values peak and decline, or peak and valley, as they say. So when it comes to the decision-making process, every asset manager has their own special sauce or secret sauce about how they buy, how they manage, and where they buy and what they buy. All of those independent thoughts have to come into the decision-making process, because it's not one decision that allows you to execute on a business plan. A lot of people in real estate would say, and I'm sure you've heard of this before, it's all about location, 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 but it's actually about location, timing, and financing. If you can find the right property in the right place at the right time with the right financing metrics, then your decision-making process gets a lot easier. From my perspective, it's been a challenge as a real estate manager over the last 5 years, because if your model is based on cash flow and you're operating your business on, say, a cap rate, and you want to make sure that you're, earning somewhere between 5 and 7%, let's say, variable mortgages and the real estate sector as a whole with inflation between 2020 and 2023 was very hard, very, very hard to buy something that made a lot of sense for your, your overall portfolio. So I know a lot of people in the space, myself included, that we kind of took a back seat. And in order for us to drive returns for people, or to make a good return of 5 to plus % on your cap rate, essentially you need to kind of drive a little bit further and start looking at places outside of your, outside of the sandbox. Often those places are in other real estate sectors, and sometimes they're other places geographically. So there's a lot that goes into it. I think at the end of the day, if you're getting involved in real estate, you've got to be prepared for the long haul, because this is not something that you can buy and sell and you can trade regularly. You have to go in with a longer term mindset when you're looking at buying real estate, for sure.
Most people, when they think about real estate, think of their principal residence. And that's not really what we're talking about here. So forget about people's homes, forget about people's cottages. When people invest in real estate, the decision is really one of, how do we buy things in chewable chunks? And there's a distinction there between private real estate and public real estate. So what I mean is, you can buy real estate investment trusts, you can buy an exchange traded fund that gives you a basket of real estate properties, but you can also hire a firm that will go in and handpick the properties that are going to be part of your investment portfolio. And then you just buy a slice of 8 or 12 or whatever different properties that you own a little bit of all of them. The difference is between private and public real estate on the institutional side.
Yeah, that's a great question. And I want to circle back to what you were talking about, the diversification aspect of being involved in real estate. So remind me to touch on that, because I have a few, anecdotal stories that may help some of the viewership here. Ultimately, when it comes down to the difference between public and private is, on a public security side, let's say you're buying something like, RioCan. RioCan, one of the best managers in the space, somebody that I look up to as a real estate manager. They own the smart centers and things like that. You can actually own stock in that company that owns all of those properties. And if I'm buying, say, $100 worth of shares, I can trade that on the open market on the TSX. A company like, a private one like my own, which is privately managed real estate, you're in it for the longer term. So you have to go into the mindset of saying, okay, this is something that, I like the distributions. I like to be able to earn the income off some of these, real estate properties. I just want to park my money and get some of the rent roll coming in. I mean, real estate's great for that, whether it's public or private. If you're the type of client that's looking for liquidity, you might want to get involved and own a chunk of a public real estate portfolio because you're wanting to maybe buy a boat next year. That's a great place to park your money for a little bit of time. Obviously, you want to work with someone like John that'll help you pick those right stocks that are right for you. But then if you're looking to be like, you know what, I just want to make my 7 to 10% for the next 3 or 5 years, and I don't want to worry about it. I don't want to think about it. I don't want to, plumb any toilets. I don't want to fix any light bulbs. I want a manager to go and take care of it. That's where a manager like me or Virtus might make a lot of sense. Just sit back and wait, and in 3 to 5 years, when you're ready for that liquidity event, we can create that for you.
We've been hearing a lot recently about how there's been a bit of a, let's call it sluggishness in the condo market here in Toronto, where I live. And there are different points of view as to why that is. I'm wondering if you could weigh in with what your thoughts are about the condominium market in the Toronto area as it pertains to the latter half of 2025.
Yeah, sure. I mean, there's a few things there too, John, and please don't take this as I'm the be all end all expert. There's a lot of opinions on that for sure. But I think what we've seen is a couple of things work against the Toronto condo market. And certainly they had a lot of things in their favor leading up to the COVID era. I think the biggest problem they had was an overbuild and then a lack of, call it government involvement with getting permits in place, et cetera. Like I know a bunch of projects that started in 2016. They were sold in 2016, but they're just being built in 2021. And now they're being moved into in 2023. A lot of stuff happened in that era. So you had a lot of people pay, call it $200,000. Let's just go by the price per foot. Let's say they paid $300 a foot for a condo pre-build in 2016, and interest rates were right around 2% back then. Well, fast forward 9 years later, that product is now trading at, call it $1,000 a square foot. And it's because inflation has hit every single aspect of the development life cycle. It's hit the taxes, it's hit the hydro, it's hit the people putting the nails in the wall, it's hit the walls being milled. So the price per foot has gone up to $1,000. So developers have kind of gotten hurt in that era if they had contracts in place that were bonded and they secured a certain pricing. Those guys are okay. If you didn't, you're in a lot of trouble. We've seen some people falter, unfortunately, as a result of that. So I think that if permits, et cetera, could be put in place a little bit faster, I don't think we'd see the burnout that we're seeing in that condo space. Unfortunately, too, we also saw a lot of, and I shouldn't say unfortunately, what we did see is a lot of foreign investment and investors come in and buy, floors of these buildings with the intent to rent them out. Makes sense. The thesis is there because there isn't a lot of purpose-built rental, especially in the major markets like Toronto and, Montreal and Vancouver, et cetera. And, now we're seeing a compression on rates because there's an oversupply. So, I mean, it's definitely got a rocky road ahead of it. Yeah, I hope that answers your question, John.
Okay. All right. Now, it does. And I'm going to see if I can go back to the general here. Trends. What would you say are the trends in the real estate market as we start approaching the fourth quarter of 2025?
There's a lot of trends, and you know what? A lot of them are very like sector specific and regionally specific. I can speak to it from my perspective. I think one of the things that we've learned over the years is that ultimately real estate's based on cash flow. If you can get a good cash flow from an asset, as John would like to say, you can't get hurt in the dirt because over time, the market's going to do what the market's going to do. Interest rates are going to go up and down. You can't control that. Inflation's going to go up and down. We got no control over that. But if you can control your cash flow and that you're buying an asset that has, good quality income, whether that's multi-res or maybe you got a good tenant like a Walmart or a McDonald's or something like that pays their bills over time and you can manage your cash flow, let the market do what it's going to do and just sit back and kind of watch what will happen, but manage what you can manage. So I would say one of the trends that we're seeing, and thankfully we learned this over the years, is that there may be a shift to buying assets based on cash flow versus, what's hot at the time. And the reason I say that too is if you're call it a multi-res person and multi-res happens to be hot and the valuations are going up and up and up, you're kind of bidding against yourself and making it harder and harder to get good cash flow to that asset because you're paying a premium for a hot asset class. If you have the ability to, look at your acquisitions based on cash flow, well, then you don't really care if multi-res is hot because you can focus on retail or commercial or whatever. So I think what we're going to start to see is a trend that's, based more on cash flow. And for investors alike, the people that are maybe watching this, is they might look at that and say, that makes a lot of sense. I'm investing in anything to make money. So at the end of the day, I want my chart to go from the bottom left to the top right. Maybe I'll start looking at real estate as a cash flow asset versus as a long-term appreciation asset. So there could be that shift over time.
What about tariffs? Are people thinking about tariffs as an important part of the backdrop about whether or not they should be investing in real estate? And if so, what is it doing to their assumptions about what they should be expecting going forward?
That's a great one, John. Again, I think this is an area that a lot of people have a lot of things to say about this. I can tell you how I've seen it. Some of the quotes that I've got over the last couple of months, let's say, I'll give you an example. We were looking at a steel building for one of the sites, and we kind of put that on the back burner because, we've been more active in the asset gathering right now. We're looking at buying more properties as opposed to building anything there. I would say that the prices have come down on new builds and things like that because manufacturers and call it the labor and manufacturing, that kind of sector is probably getting a little bit nervous because money's getting a little bit tighter. I think there might be a credit crunch for those types of things. So people are worried about the tariffs because we do import a lot of stuff from the States. And there is that looming tariff kind of above us that we're being told about it every day in the news. You can't turn on the TV and there isn't some sort of mention about it. So I think investors, developers, even Joe Lunchbox over at you name it, everybody's kind of concerned about it. Am I concerned about it when it comes to buying real estate? Again, if you're buying based on cash flow, you just want to make sure you're buying good industries. I'll tell you that one of the things that we're concerned about is if we're looking at a manufacturing facility or something along the border that could be impacted by the tariffs, we may be taking a back seat to that type of asset and probably looking for something a little bit more established in the secondary and markets here in Ontario.
So let's talk about the US a little bit more in terms of the way Americans are looking at the situation. It seems as though the US economy is starting to slow down. It's experiencing a moderation. And I think that's especially true for working class people, lower income people. In the rest of the Western world seems to, at least up until now, be doing more or less okay. Should there be any kind of a way that we change our views with regard to real estate, given that the US economy might be actually softening more than the rest of the Western world? And this is still with the tie into tariffs. There's a real viewpoint that the tariffs are a de facto tax on the American people. And as a result, American people will be in a tougher situation with regard to their finances in general and with regard to real estate in particular in the not too distant future. Maybe you have some thoughts on investing in real estate in the US versus in Canada. Do you think there's anything that's particularly unique to real estate in the US in this environment?
I just actually got back from Denver. My wife and I went down with another couple. We were actually there when the Blue Jays set all those records against Denver and they whipped them down there. That was great. And what I can tell you is that the tariff conversation that we hear here in Canada versus what is actually being told in the States or how the sentiment is with the American consumer is vastly different than how it is up here. I can't tell you how many people came up to me and said, we're really sorry about all this tariff stuff. Please continue to come back to the States. We love your business. We want to do business with you. Ultimately was the sentiment. So I don't think that there's a bottom up approach to this whole thing. And you nailed it. It is a tax on the American people. There's a lot of small business that rely on our steel, our lumber, on and on that are now being affected by it. So, my thoughts are that I feel bad for them and I feel bad for everybody that's affected by it here, and their bottom line and your ability to put food on the table has changed drastically as a result of a leader's mandate to effectively increase a tax on a population. So it just sucks. I don't know what else to say about that, John. When it comes to looking at real estate opportunities, in light of what's happening with the political risk that we're seeing with our two nations kind of feuding a little bit monetarily, it is concerning because there's a lot more factors when you're buying in the United States versus buying here. I mean, you have currency, you have taxation, the taxes, state by state significantly. So there's a lot more risk to it. What I can tell you from our perspective and what we're seeing as a Canadian asset manager is that, we have enough stuff going on up here. It's hard to keep up with our mandates up here. I mean, who would have thought the Liberals would have got in power this year? Really, if you were a betting person back in January or February, you would have said it was conservative all the way. So following that political theater has been interesting. All of that to say, I think that if you're a Canadian manager, or at least us, we're a Canadian manager, we're looking in our own backyard. We're looking after our own, much like Donald Trump's wanting to say that he's looking at his own. We're looking after our own. We're investing in small town communities. We want to just focus on what we know. And at the end of the day, John, we like going to properties that we can see, feel, touch. I can walk into the store and buy a burger at some of the units, So if you're a real estate investor, I think that's pretty important when you can go and kick the dirt. So if you're looking at acquiring stuff in the States, it's a little bit harder to do that. Matter of fact, back to my Denver story, we actually got pulled into secondary at the border. So it's, it's a little bit more challenging to get down there and walk around your sites. That's for sure.
All right, Jeff. So a moment ago, you said there were a few other things that you were hoping we could get to at the end before we ran out of time, and we're about to run out of time. So this is my chance to see if I can ask you to maybe if there was something that you wanted to get to if you had the time.
Yeah, sure. There's this market is presenting some unique opportunities for asset managers and people wanting to get invested into real estate. I actually had an opportunity to speak with investment executive last week about real estate. And I think the article was just published I think it was on Friday, August 20th, somewhere around there. It was called A Real Estate Dip. And the theme was kind of talking about office real estate. So they reached out to us because we don't have a lot of office real estate. So I think they were maybe looking for a smoking gun and for me to kind of talk poorly about it. But what I will say is that I think that they've turned a corner. I think the office has turned a corner. I spent a lot of time with firms actually like yours that design securities. I spent some time getting downtown and speaking with some of your brethren at the other shops. And what I've seen is more and more people downtown, more and more traffic on the GO train, harder to get reservations at lunch. So there is that, mandate to get back to the office. But what I do think is happening too is, we've seen rates kind of come down a little bit. We've seen that there be a crunch on credit per se, where it's harder to get loans and values have come down a little bit. And that's an unbelievable opportunity for people getting into real estate. As Warren Buffett used to say, when everyone's running for the door, you run into it. And I think that this is one of those markets. My partner Aurelio has been doing this since, the mid 1980s. And he's been through some significant ups and downs. In the late 80s, we had the bust of the housing crisis. We had the tech bust in the early 2000s. Then, of course, we had the credit crunch with the North American real estate in the mid 2000s. And I think we're seeing an opportunity that's even better than that now, where, rates are kind of holding pretty steady. Values are starting to make sense to get into real estate again. And what we're seeing too is also an aging demographic of real estate managers. And this is the story I wanted to tell you, John. We've also got a little bit of media coverage over the past couple of months because our firm, if I can talk about our mandates here for a second, is to buy based on cash flow. And we've figured out a unique way to build our portfolio without actually using a lot of cash. And there is a rule in the Canadian Tax Act called the Section 97(2) rollover. So, if you have a real estate asset and you're aging, and let's say you have 10 of these real estate assets, and this market isn't ideal for you to sell in because prices have come down, there are ways to actually monetize your equity. And we figured out a way to do that. So the story I was going to tell you, John, is that we've actually got 5 assets under control right now that we're probably going to close on for managers that have one single asset and they want to diversify their position because they've only got, let's say they have $5 million tied up in this one apartment building. We could actually swap them units in our trust for their property. We'll take over their debt. And now their $5 million of equity is across a pool of assets as opposed to in just one. And that's, going back to the trend, that's a trend that we're seeing as an asset manager, specifically in the secondary, tertiary markets. And it's a unique opportunity for those that really want to grow their portfolios. This is a way to do it when cash is hard to come by. So there's always a way, as my mom always used to say, if a door closes, a window opens. So just find your way in. So
Josh, I want to thank you for your time today. I've got 2 quick announcements for the people that are listening. First off, if you haven't already done so, please like and subscribe. We need more guests like Josh, and your subscription helps us to get that. And then secondly, I've got an announcement. I'm going to be speaking at the Toronto Convention Center on Friday, the 12th of September at the Money Show. So for those of you who are around, please, it's free. Please take the time to come to the convention center. I'd love to say hi. The presentation is at 4:00 on Friday the 12th. Thank you so much, Josh. It's been a real pleasure.
Thank you. I'll see you on the 12th.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.